Hi everybody, welcome to the video. Today we are going to talk about a very different way of doing an Iron Condor. Retail traders bearish Iron Condor tactics. Before we start, I have to tell you standard disclaimer, strategy explained is only for educational purpose. Options trading contains risk to capital. Knowledge which help you become better trader. Number 1, the Iron Condor reality. Let's talk about it. And also let's talk about the market as well. So here we are on a strategy builder. Basically, Iron Condor is a combination of selling and buying the strike. I'm going to show you the payoff, but before that, what I want to tell you is that currently the market is hovering approximately 25,600 approximately. Now to create a short Iron Condor position, one has to go out of the money, that means above the market, sell an option, and then go more up and buy an option. Same situation one can do at the put side as well, is that we can sell a put option and then we have to buy up. So basically it's a combination of two spreads, a call spread and a put spread. Now when we create a spread like this, how it looks? This becomes your Iron Condor. Again, very popular strategy now. The reality of Iron Condor is that if market remain where it is, and first of all, it's not a very high range, which you can see over here, right? The range is not so big. But at the same time, if markets start to slide in either direction, what you find is that the red zone is very big and thick. Iron Condor was very popular a few years back. Even now, a lot of people do Iron Condor because the short Iron Condor benefit from the theta decay. That means every passing day, we expect some kind of theta decay to happen if market remains in the range and if market is not volatile, of course, right? In that situation is the core concept of Iron Condor. But if you just look at the payoff, what do you find? That an Iron Condor doesn't really look like a strategy which has much of the power aside from the theta, because the range and other things we have spoken about this. So this is the real reality of Iron Condor. Now I want to build a bearish Iron Condor and we're going to discuss about this. Before that, I want to show you the chart of the Nifty, and can we take any directional bet is something which we are going to discuss. So here we are on a Nifty daily chart. Every candle represents one day. I want you to really focus on what you are learning on the screen at this particular time. What do you see? That market from here 24,700 really ran up to a level of approximately 25,600, approximately 700. Now such a big rally has happened in the market, especially index. So naturally, there are a lot of people who are bullish about the market, a lot of people who are bearish about the market. Now, obviously, this is not a trade recommendation by any chance. But suppose that if your view is bearish and you are a mean reversion trader, in that situation, what one can do is there are other strategy, for example, selling a naked call. Now, selling a naked call can come with a lot of risk, or probably making a ratio spread. I mean, buying the call and selling multiple calls. There are a lot of things which one can do. Suppose that if you are a mean reversion trader. So I've already made a bearish Iron Condor for you, and I'll show you how this looks. Now we're going to discuss about the bearish Iron Condor, and obviously I'm going to tell you adjustments as well, which I'm sure you would like to learn from me. Now here what we did is that we did the exact same thing. It's just that we never sold the call option which is above the market. We are selling the call option and buying the call option. Both we are doing around where the market is, around at the money. And then we are going really further down and then we are selling and the buying. So the core concept of Iron Condor we never touched. It's obviously one leg selling and one leg buying in the same series, but we have moved our strike bearish. Now when you do something like this, you get a payoff which is obviously bearish because market is here and we can see a vertical line. This is where the future is trading at the moment. Now I wanted to compare this with the neutral Iron Condor which you make. As you can clearly see that in terms of the strikes, in terms of the red zone in our simulator, this one, if you compare with the bearish, which is this one, there is a starking difference happening here. Now I want to really bring your attention to one very important concept called IV. IV basically decides the price of an option, and put IVs are generally expensive than the call IVs. I've given you a hint of this in my previous video so that you can dig more deeper and you can probably try to make a Condor on any other strategy a little skewed, in which we really took care of if what is the maximum reward in this if things go right versus What is the maximum loss which we have if things go completely wrong? Always remember, trading contains risk to the capital. We got to be prepared for the worst. At the same time, we got to understand that we are making a bearish iron condor. Suppose if you are thinking that market's gonna fall down and market may just go to the mean, if this is your view, in that situation, this is how your bearish iron condor will look like. Now, when a trader actually trade in the real world, an iron condor, what are the two possibilities which can happen? Possibility number one is that market can really shoot up. If market go up, then what you see this red zone, of course. But if market flips back a bit, what you see is that we plan to make it a lot favorable for us, because this green hump which you see in a simulator, this is obviously much bigger than the red zone which you see. There is no doubt about that. But let's discuss the worst situation, because if market snaps back a bit, then market is expected to be in the green zone. But if market continue to go up, then what is the adjustment which I'm sure most of you would like to learn? So what to do in that situation? If we take a reality check that market has already gone up. Now, if you are a trader who like to trade mean, suppose market go even more up and suppose market come here. Remember, this is an index, this is not a stock, right? In that situation, obviously one can exit from the trade if you like to, but there's one more alternative which one can do. Suppose market from here 25,648 becomes 25,900 approximately. In that situation, obviously the put side, the put lots which we sold, that is something which we can expect the price to reduce. This 25 point option can become really less, and maybe it becomes somewhere around 11, 12, something in those lines. We are assuming that it drops by 50%. Now we can obviously completely exit our put side, but now the call side which we have, we can look forward to double the quantity. Exactly. So what we can do is, we already have long and short one. What we can do is, now we can long and short two. That means we are adding one extra quantity to this. Why are we adding extra quantity on the call side is what I'm going to tell you in the next few minutes, right? So it's very easy so far. We can remove the put spread, because obviously put spread we expect to go in our favor because market has gone up. At the same time, we look forward to double the quantity of the calls. Why? Because market has more gone up. So earlier, if your conviction was that market may just drop, now market is even more stretched. And the put side which we exited, now the put side is also going up. So it's very easy actually. Call side, double the quantity. Put side, bring it up. Very simple. We keep it very, very simple and easy to understand for each and every one of you. Now what do we do is very simple. We just simply go little up in our put spread. We sell this, we keep the quantity one, and of course we buy the cover. So this is how it is. And when we do this, how the trade is expected to look is I wanted to show you. When you do something like this, the trade will expect to look something like this now, right? Obviously, it's a simulator, so we don't have a loss yet. In the real trade, you can expect some amount of loss in this. But now the best part is that when market has gone even more up and you have moved your position, if market continue to go up, then you can expect what is going to happen with this, suppose, right? Because if market continue to go up, in that situation, you can see the red zone is the flat line which you see. But if market reverse now, in that situation, because you have bought an extra leg of call and you have made the situation even more bearish, if you are somebody who's expected for market to go down. So the basic idea is that we start with a little bearish iron condor. If market reverse, it's fine. That's what we expect. But if market go up and now the mean revision is more strong, then we go even more bearish by adding an extra layer of legs. So that is how one can play, but I have some more points to tell you now in this. One important point is the timing of bearish iron condor. There has to be some kind of a directional view if you follow the stretched market or any other way of trading which you may have. Bearish iron condor is obviously, as the name suggests, go by the name of bearish. Now, common mistakes is number one, that holding your trade till the end. That is not advisable, of course, because gamma effect may come into play. And number two, entering without any directional view. That is something which we should not do in a bullish or a bearish iron condor. That is something which you absolutely must take a note of. So basically we are doing the same condor strategy, but you could see the difference when you make a neutral one or when you make a bearish one. It's all the IV play which is happening. That's the exact reason why I say hit and trial way of trading one must completely avoid. You can obviously learn to tweak your methods, your strategy, and make it even better, suitable to your view of the market, and take advantage of IV like I've demonstrated to you over the simulator. Thanks for watching, and I wish you all the very best. Take care. Bye-bye. Signing off.